Hi everyone, MichelleMortgages.ca here. What I'm about to explain might look as complicated and as messy as the graffiti that's behind me, but just like street art, once you step back and really look at it, the picture becomes pretty clear. Japan made a move last week that shook the global markets. And yes, it could affect your mortgage rate here in Canada, even though they didn't raise their interest rate, believe it or not. So, what did they do? And why does it matter to us all the way here? Let's break it down in simple terms. Think of a central bank like a thermostat. It has two knobs. One knob is the short-term interest rate. The other knob is like the long-term bond yields. Japan didn't touch the interest rate knob. They adjusted the bond yield knob. And for years, Japan kept a tight lid on their long-term bond yields. So imagine holding the lid down on a pot of boiling water. Last week, they lifted the lid a little bit. They didn't change the main interest rate, the one that affects the credit cards, the loans, and the day-to-day borrowing. They just stopped forcing long-term borrowing costs to stay artificially low. They let the market breathe a little bit. So here's the part that most people never hear about. Japan is one of the biggest lenders in the world. So when Japanese bond yields rise, even slightly, investors in Japan start to think, well, maybe I don't need to go to the US or to Canadian bonds anymore. Maybe I can keep my money at home. So they sell some of their US and their Canadian bonds that they've been holding for some time. And when big investors sell bonds, the yields on those bonds actually end up going up. So in Canada, our 5-year government bond is directly tied to fixed mortgage rates. So a move in Japan, literally across the world, can ripple right into our real estate market here in Canada. Now, why didn't Japan raise their interest rates? Well, that's because rising interest rates hit their entire economy at once. It's like flipping all the light switches on in the house, I guess you can say. Letting long-term yields rise gentler, it's like opening a window instead. So Japan is trying to move back into what's called normal, slowly, without hurting their economy. So they chose a more softer option. Bottom line, Japan didn't raise their interest rate, but by allowing their long-term bond rates to rise, they triggered a global chain reaction, and that includes bond markets and mortgage rates here in Canada. So even if it looks messy or complicated at first glance, once you understand the bigger picture, it actually starts to make perfect sense. So like always, if you made it this far into the video, thank you for watching. My commitment is always to try to help Canadians understand the connection between politics and policy, and how policy impacts mortgage rates and affordability. And sometimes even a decision made halfway across the world eventually makes its way back to Canada. So, if you've gotten this far, thank you so much. I hope you enjoyed the video. And if you liked it, please, share it, like it. I'm not always one that's chasing algorithms, but I am definitely committed to helping Canadians. So I guess the algorithms are really what's going to help me get there, isn't it? Thank you so much. And until next week, be well.